Hi, this is Pat with Energy Solution Partners sharing with you our energy market view on Thursday, January 9th. Keep in mind there is a risk of loss when trading commodity futures and options. I want to start by sharing with you a little bit of the seasonal history over the last few years, what we've seen in the heating oil market. And this is a chart of the May futures, so kind of focused toward that spring time frame here with our spring demand. And as we look at where this has been over the last several months, we've been in about a 15-cent trading range, and this year is matching up with what we've seen the last few years, so right in that same range. Since the first of the year here this year, we have seen a big drop in this market, and so today our May futures are actually priced quite a bit lower than they were back in 2012, 2013, even though we're at some lower inventory levels, which I'll show you in a bit. But the interesting part that I find in this chart is where this market has moved from this point going forward. And you can see 2012, 2013, from this point forward, we just continued to climb and experienced a 25 to 30 cent increase from this point going forward. So that's definitely in the cards. We've seen it play out the last 2 years, and I'm not sure why 2014 would be a whole lot different than where we're at 2012, 2013, especially as we look at our current inventory levels and how they stack up against those 2 years. So the stars are kind of lined up. If we do trade on true supply-demand fundamentals, which I think eventually it does come down to supply and demand. As we look at some of the DOE statistics here, they focused a little bit on the refinery utilization, and the refineries have been running over 92% capacity for the last several weeks, and that's just a huge number for this time of year. And this 92% is where we typically see it peak out in the summer time frame. So the refineries have been running pretty much all out, and looking where these rates have gone from this point forward, again looking back at some history here, and you can see the tendency for these rates to start to drop off this time of the year as we go into the spring time frame. And the reason for this is the seasonal maintenance that comes about every year. The turnarounds will start here, and they start from the Gulf Coast and work themselves north here into the spring months. So we're going to want to watch this. We're sitting at some pretty high levels today, and watch and see where that goes if it follows the tendency that we've seen the past several years to drop. And our concern, if we see this utilization fall off, we're not going to be able to build inventories, and we're starting at some low levels with heating oil inventory for the year, and we're going to watch that moving forward. And here's our distillate inventory as reported this week from the EIA. So we're starting at the lowest levels that we've been at for this time of year over the past several years here. And again, at these low levels, even though the refinery utilization has been running up at 92% capacity. So these refineries are running all out, and we're not building inventory. And the reason behind this is exports. The export demand has been very strong on both gas and diesel. And for that reason, we just have not been able to build the inventories. Just going back to a daily futures contract, again, since the first of the year here, we've seen about an 18-cent sell-off here for whatever reason. Now, the last few days, we've seen some consolidation in the market here, so we'll see if we get that rebound. I guess that's my expectations. Not real sure why we traded off here since the first of the year, if there's something else behind this market that I'm not seeing. But going back to the fundamentals, I am very concerned about the current supply situation and the strong demand that we've had. And the other item, I guess, that is leading us to believe that we're probably near a bottom here, and I've shared the stochastic study in the past on the daily chart, and we have moved into this oversold area here, which means we're just ripe for the buyers to come in here, speculators to move this market quickly, as we know that they can. Again, I want to share with you the chart of the forward curve of the heating oil market. I'm not going to spend a lot of time on this, but the picture is the same as we've looked at before. The front months are priced quite a bit higher than the outer months, and this is just a sign of a bullish market structure. The market's willing to pay more today to take delivery of the oil than it is to pay to store the oil. So classic bullish market structure, probably coming back to the low diesel supplies that we're seeing, along with some pretty strong demand and export demand here. So we'll continue to watch this for any change in this forward curve, but it has been in this type of structure here for a few months running here, as I've been sharing with you. With that, if you'd like to discuss any strategies at all or look at some forward contracts, we'd be happy to visit with you, give you some current quotes, look at some option strategies. Feel free to give us a call. We'd love to hear from you. Thank you.